Hello and welcome to episode 16 of Informed Choice U. In the episode today I talk about active and passive funds. Hello and welcome to another episode of Informed Choice U, Personal Finance and Investing Explained. I'm Martin Bamford. In this episode, I talk about active and passive funds. When you invest money in a collective investment fund, you have a choice between active or passive fund management. Some investment funds are actively managed by a fund manager or team of fund managers. With this style of fund management, the manager makes active decisions with the aim of beating the benchmark return. They do this by attempting to exploit inefficiencies in the investment markets, for example by buying stocks they believe are undervalued or taking overweight or underweight positions in different sectors or countries. How well an actively managed fund performs will depend on the success of the manager in choosing stocks or sectors relative to how the benchmark performs. There is no guarantee that by paying for active fund management, you will get a better investment return than the benchmark index. In fact, the fund delivery could be a lot worse than simply buying the entire index through an index tracking fund. Investors choose actively managed funds because they believe the skills of a fund manager will result in a better performance than using a passively managed fund to simply track an index or sector. Academic research shows that the majority of actively managed funds underperform their benchmarks once management charges are taken into account. With passive fund management, the fund aims to closely track the performance of a selected market index. Passive funds are typically cheaper to run than actively managed funds because they don't require the same level of research and manager input in terms of fund selection. These funds are often called index trackers. Passive funds are becoming increasingly popular here in the UK, where they now represent around 11% of the retail fund sector by assets under management. They are even more popular in the United States, where passive funds are the preferred choice of investors. Selecting a suitable passive fund requires the same level of care as choosing an actively managed fund. Investors need to consider how the tracking of the index takes place, whether this is through full physical replication of the underlying stocks or using a synthetic tracking method, which relies on the counterparty to provide the index performance in return for a fee. Some passive funds have a large tracking error, which means the return the investor receives after charges can be quite a bit lower than the index return. Thank you for watching this episode of Informed Choice U. To watch more episodes and subscribe to receive updates, please visit www.icfp.co.uk/ICU.